Small banks are in trouble. Small banks are finished. What's happening is because of the chaos that happened, a couple of weeks ago with Silicon Valley Bank, what's happening is many people are seeking the top 4 banks for debt. In this video, I'm going to tell you what that means for people who want to raise money. So basically, it can mean a few things. Number one, people who want to raise money, it could mean that you need more institutional investors for debt. Many people are losing faith in the small banks that have collapsed. So a lot of people have been focusing on more institutional lenders, such as the top 4 banks. So in case you didn't know, this is JP Morgan, Bank of America, Citigroup, and Wells Fargo. So these banks, and I'm going to tell you a few reasons why. One is because a lot of banks had their value based on the amount of debt that they had, but they literally bought loans, because a loan is basically the same thing as a bond. So they had a lot of bonds which their value was based on, but the problem is because interest rates went up so sharply, the value of the bonds went down, because the value of bonds go down when interest rates go up, because you're paying more money. Because if you own a bond where you're paying more interest, then the value goes down. So that's reason number one. Number two is a lot of the bonds that were held had to do with commercial real estate, because some of the smaller banks, they take more riskier investments in offices and commercial real estate. So the problem is that because a lot of occupancy rates of offices in America has gone down after coronavirus, especially in the West Coast, a lot of their portfolio has taken a hit. And then number three, this is the obvious one, where people are laying people off. So, when the economy slows down and the government's purposely trying to slow everyone down, things would take a slow bus. So when you're in this kind of market, people are going to have less faith in the banks that just collapsed. So the big 4 banks will be the ones who underwrite more loans. So as a result, and what you're going to see, so if you want to raise money for a deal, and what this means for you, if you want to raise money to buy real estate, you may want to look at the more institutional players, or somebody more direct to the institutional players, or brokers who are more direct to the institutional players, because the underwriting criteria may be more fussy. So because of this, you're also going to see maybe lower LTVs. Because the big 4 banks, they're less risky, they're more stable, you're probably going to see more people needing to raise equity, because equity is the counterbalance to the debt. Like if you go to with a more high risk bank that would probably send you money more quickly, you may not be able to get as much approvals from those banks. So you may need to raise more equity, and equity just means money that is not owed to anybody. It's not a loan, it's basically raising money to sell ownership in the project. That money would be more valuable if banks are more resistant to lend, if people are more resistant to lend.